Things are a lot more expensive nowadays. Looking back at April 2021 to today, things on average are 13% more expensive. That's not including groceries. Groceries is 20%. That's not including gasoline. Gasoline's 23% more expensive than it was back then. It's even expensive if you don't want to go out there and drive and go grocery shopping. Just staying at home, turning on that electricity will cost you 21% more than it did back then. Globally, US, Canada, or other Commonwealth countries, all these central banks that belong to all these countries have one thing in common. All the central bank want to reduce inflation. This objective of reducing inflation for all the central banks of all these countries is actually a shock because inflation actually reduces the real income of their citizens. Around, I think it was March 17, 2021, a historic day when Jerome Powell has said the word transitory, referencing his expectations of how inflation will behave. He thought it'll just come and go, or whatever definition his transitory timeline would have taken. As we can see now, today, May 2023, it wasn't transitory. He was very, let's just say wrong, just to put it nicely. Jerome Powell's reason for using the word transitory was because he really thought that, the cost of having things a lot more pricier during this time of period, during the pandemic, were gonna revert back to how they were once the pandemic was over. And now that we are living in this time, we know that wasn't the case. It wasn't transitory, and things that took place in the pandemic are still up there in prices. So what can a lot of these central banks do? Well, for example, the Federal Reserve has one asset in its toolbox to help reduce inflation, and that's, as we know, hiking interest rates. And the thing is with interest rates is, as you change the interest rate, it's not clearly a science. It's more of like an art. Different sectors of the economy will respond differently to these rate hikes. And as these different sectors of the economy react differently to interest rate changes, so do the, investor asset class or the saver class. The ones that invest will benefit from this. The ones that are savers will hold the bag or they'll lose. So why does inflation persist? Why is it so sticky? Why does it stick around? Who's benefiting from this? Welcome to the Financial Almanac. My name is Basil, and let's get right into it. Inflation is just the change of prices that is increasing from buying products or purchasing services in our economy. Inflation can happen for many reasons. One example is supply-demand relationships. When there's too much cash, that might be a reason. When there's not enough of what you were demanding, whether it's a product or a service, that also might cause inflation. Another reason inflation can occur is, businesses will increase their costs. Because of administration or logistical or operational reasons, prices go up for them. They share it down all the way to their bottom line. Their prices increase. The consumer has to pay more for those services or products, and that's inflation. Now, a lot of this has happened globally at a large scale, and that's why prices have increased and inflation is here. And one thing that was very shocking to our global economy was that prices have increased at a volatile rate. Even though that prices was very high and volatile, things have slowed down now and gotten a little bit softer, a little bit easier, but inflation is still here. Due to the pandemic-induced stressors that has increased the inflation in our global economy, things gotten a little bit better now, so it's not as bad as it was, but it's still up there. It's still very real. Inflation is still here and it's very persistent. And because of that, prices are struggling to stabilize and decrease. It's not easy for small businesses or even regular day-to-day name brand retail businesses to figure out what's the right price for the consumer. When businesses ask themselves, when's a good time to change these prices? Here's what they go through. Some goods in our society change quite frequently. If you were to visit the gas station, prices change quite often. But on the other hand, things that are a little bit more, less changing are things like rent, college tuition, even movie tickets, And this is a challenge for day-to-day people because guess what? You put something in your grocery basket and then next time you visit the grocery store, it's definitely changed. This creates an unpredictable, consumer society because we don't know how severe, volatile, and what would happen next in our economy. And because of this mental calculus that people have to do in our society, it's not a good feeling that our businesses are reflecting to their consumers. And because of this, we'll see some companies actually stabilize their prices, try to, give some relief to the consumers that visit their retail stores. Another variable that can affect inflation is actually inflation expectations. When consumers expect inflation to occur, they'll go out, purchase their things because they believe it's going to get more expensive next time they visit. And because of that heightened demand of purchasing things before they increase prices, that increases prices. And whether you're a consumer or a producer or even just a retail operator, if you're going to expect inflation to be around longer, you're going to increase prices and have that stabilize, right? You're going to purchase more today, right, as a consumer, expecting prices will increase, and you're hoping that it'll stabilize at that price because you got the deal today. Same thing for a business. If you're a business, you can only reset your prices a couple times a year, right? Because of what we talked about, your firm's appearance, your branding. So you don't want to shock your consumers, so you expect, inflation's coming, let me raise my prices to this much and hold it there, right? That way you can keep your consumer loyal. It stays at that price for a while, and you're not expecting another reset for a little while. And because we're building in this expectation higher for longer, well, inflation stays around higher for longer. But if you expect prices to stabilize and the Federal Reserve or your central bank will basically fight and help get rid of inflation, then that helps you stabilize your budget as well. So that's another component of fighting inflation, is fighting inflation expectations. So when inflation expectations are high, that affects our behavior. Imagine you're used to a certain standard of life in your grocery shopping list and things have gotten a lot more expensive and you want to maintain that lifestyle. So therefore you're going to start thinking to yourself, man, I got to make some more money. I got to increase my wages or my income. And when that happens, you go to your boss or your business and you're going to ask for an increase, whether it's in wage or just find out more money. Finding more money basically will have to be transferred to the consumer. That's how the business would generate more profit they can pass off to their employees or workers, and the consumer holds the bag again. Thus, it's a vicious cycle, right? It's like a negative feedback loop. And because of this feedback loop, that's what we call a wage price spiral. So in a wage price spiral, prices of products and services are higher, employees will ask for more wages, and that in turn increases prices even more. And then the employees will ask for more money, and then that spirals up. As you can see, that's why they call it the wage price spiral. So some economists will also say a strong labor force, or what they would call an overheated labor market, might be a reason for pushing up inflation as well. And during this wage price spiral, there's going to be a lot of tension there because, firms and companies are basically profiting from profit sharing, and workers are usually losing, that battle, and they've been losing for decades. Some economists out there will say that the supply-demand relationship isn't the reason for our inflation in this current cycle in May 2023 because, there is enough supply. They're saying that supply chains have opened up, but their reason would be because of wage price spiraling. During the height of the pandemic, there was a lot of stimulus checks given out in our economy, and that caught back on a lot of workforce employment. And, employees were basically, sitting at home collecting checks, but employers were finding trouble for hiring workers. And because they were finding trouble hiring workers, what happened was the businesses would increase their wages to attract more workers. And because of this dynamic, in the beginning of 2021 all the way to the middle of 2022, we've seen record high wage increases, high turnovers for these businesses, and a record low of unemployment rates. In 2023, this year, we're seeing already a lot of layoffs, a significant amount happening in different sectors of our economy, but especially in tech and whatnot, as we covered in our previous video. And we're seeing wage growth is cooling. And this is significant because that will help fight inflation. And since companies are asking their workers and the labor force to please stay where you are, they're going to offer higher salaries. And due to this overall effect that took place in our market, the only way to get rid of that is actually to, increase layoffs. It's challenges for businesses because even small businesses had to hire people and overpay their wages for the same force they used to get it for cheaper. And because at the end of the day, the small businesses and other business sectors as well had to be profitable, one thing they had to do was basically cut back on their labor force, because that's one way that, to increase profit. Normally in inflationary periods, wages don't keep up, and it's usually products that are increased and the cost of labor tends to go down. So this was an unusual episode where we saw that inflation, economists believe, was because of the amount that the labor force was costing the business sectors. And in this instance, the workers were generally gaining. So when central banks have to think about tackling and fighting inflation, central banks have to do a balancing act because they don't want to stop prices from rising completely. Jerome Powell and the Federal Reserve have not only given a 2% target for the rate of inflation year over year, but also 2% is considered by them a sign that there is a growing economy. Their logic is if they have no inflation, then nothing is really growing. Everything's just generally flat. They're looking at history when times had extremely low, if very low, rates of inflation. They'll also notice that there was very low or extremely low rates of growth in the economy. Their goal is to make price changes grow so minimally that people won't notice, the businesses won't notice, the households won't notice, because it won't even be thought of. So the Fed uses their primary tool of monetary policy to fight inflation. So the Federal Reserve will increase their interest rates to help fight inflation, helping slow down the economic growth, help slow down the demand for products and goods and services. But when the Federal Reserve increases rates drastically, that reduces the impulse for consumers to borrow and the option for banks to lend. And with the Federal Reserve or the central bank increasing rates and the banking lending being a little bit more tighter and borrowing from consumer being a little bit more challenging, this reduced nominal circulation of cash. And when supply is still coming in, you have more supply, less cash to buy things. Guess what? That reduces the price of those things and those goods. The main goal of central banks during this inflationary battle isn't so much to lower prices. It's just to slow down how much they're growing by. When prices go down below where they were originally, that's called deflation. And during a deflationary period, people will start thinking to themselves, why would I go buy that thing or purchase that service when I know tomorrow my cash will be more valuable, that product or service will be cheaper, so let me just wait and prevent myself from buying because I can get a better deal. So deflation is usually, in a state of very low demand and in a recessionary state. And oftentimes during increased interest rates, this causes a lot of pain for consumers. When you're increasing inflation and reducing demand, this usually affects the labor market and it weakens it. So when central banks want to reduce inflation, that means labor markets weaken, consumption weakens, and that could lead into a recession. No policymaker at the central bank is pleasant about this, but it's a tough job and that's what they have to do. They understand that, hey, we got to bring down the economy, we have to slow it down in order to combat inflation, because the last thing you want is hyperinflation in the economy. So they will risk, the chances of a recession in order for the longevity of the economy to be more healthier. So the outcome that they want after the recession, right? Ideally, there's Jerome Powell saying there might be a mild one, but after that, they want a low inflation where generally things are stable and nobody's talking about it. And that's really healthy, not only for the United States, but for other central bank economies and countries around the world. And when it comes to consumer behavior, there is a way to influence inflation to be lower. There is a quote in society that says, nothing cures high prices like high prices. And when consumers see a higher price tag, only a small portion of consumers that used to shop there will go and afford those higher prices. And thus, because supply is still normally coming in at a very steady rate, the business will say, hey, those high prices are not giving us as much as we used to have in profits because only a smaller fraction of consumers are buying and supply is coming in regularly. Let's lower prices so more consumer percentage can come in and afford those prices and thus go back to normal. So high prices can cure high prices in the long term without the intervention of the central bank. So when customers and consumers and clients basically are saying, hey, I'm not going to buy this anymore, it's too expensive, what oftentimes will happen is they will substitute for another item that's more in their budget. And that will signal to the businesses, if supply comes in steadily, that hey, nobody's buying their previously high ticket items and supply is coming in, let's reduce these prices. And the people that you had to compromise for their budget might be incentivized when prices get adjusted to go back to their quality of life. So as of March 2022, that's when the Federal Reserve started increasing their hiking rate. So it's been about a year now. So the Federal Reserve thinks what the economy needs is what's happening right now, where there is slower growth. We just had GDP at 1.1 recently, but the general cost of prices is still higher than what the Fed would like to target at 2%. The Federal Reserve not only uses CPI, which is Consumer Price Index, they also use as a measure of inflation, PCE, which is Personal Consumer Expenditures. As an inflation indicator, PCE had peaked back in April 2021 at 30%. As of March 2023, a couple months ago, PCE has dropped in the rate of change, so it's only increasing by 6% year over year rather than 30% like it was back in April 2021. So a lot of economists that work for the central bank and other major market strategy firms are considering a 6% PCE, considering it being more normalized compared to what we had experienced. Because this is occurring without a recession, consumers still have a lot of money that is sloshing around in the economy. And just to see whether or not there is a lot of money still sloshing around in the economy, try to book a reservation and see how populated that restaurant is, or try to book a vacation and see how packed those beaches are. You're gonna see it's still there. And because people are still out there, spending money, it's still one reason why inflation is so sticky. So generally speaking, the US economy is one of the only economies, if not the only economy in the world, that can actually export inflation, because all they have to do is, print some cash up and people will give us actual materials and hard goods in return for that cash, right? So what happens, for example, when you send, the cash that was just printed at the Federal Reserve to Mexico to buy, say, avocados? Now, the Mexican economy will probably, during an inflationary period, have those avocados increase in price, right? And so when we import those avocados to the States, that market increase that took place in Mexico will be reflected on our shelves over here as well. So sometimes that inflationary export can also be still imported either way. And because of all of these dynamics, is inflation still sticky? Is still a really big question, right? And the jury's still out on that, whether this will occur for the rest of the decade or will we get over in the next few years. The markets are saying we can get down to about 2% rate of inflation at the end of about 2023, 2024. It still might stick around till the end of 2024, which is still considered a win because we're not thinking decades, we're thinking 2 years. So the Federal Reserve believes that sticky inflation might still be around and a target of 2% will be hit by 2025. Yes, they will be risking a recession and it's feasible with a soft landing. But overall, I think it's a risk-reward ratio that the Fed believes they're willing to take. Even though it might not be desirable, their expectations are it would be a shallower recession compared to the average recession we've experienced. Only time will tell whether or not it'll be the right trade-off in the long run. Their goal is, at the end of 2025, for inflation not to be at the forefront of everybody's conversations anymore, and it's just sort of on the back burner, right? So this is when they know that their policy is working and their battle against inflation is winning, because it's at the back burner of conversation and not a lot of people are thinking about it like today at the forefront of their mind. And one last thing I want to talk about is inflation does persist during a recession. When there is still an inflationary factor where prices are still up and demand is still there and it's still being met by, the slosh of money that's going around, and we experience a recession where there's a rise in unemployment and things like that, that is what we call stagflation. Now, stagflation is the worst of the worst because inflation is still high, unemployment rate is still high, and people have money that have it. People that don't have money can't afford anything, and it's terrible for the economy. The labor force that loses their job actually pay the biggest price. People that have assets and investments tend to still do well because they are paying those premiums on products and services, and so the economy gets even a bigger division between the lower and upper class, the middle class sort of slowly deteriorates even more than ever, and stagflation is historically terrible. It's the worst of the worst, and we might be in one. But not for today. That topic's for another time. Thank you for being here at the Financial Almanac. I'm your host, Basil, and I'll talk to you guys later. Bye-bye.